One major consideration if you're a retailer in approaching the U.S. market are the transfer pricing regulations and the penalties that can be incurred if you don't comply with them properly. Transfer pricing regulations set forth how a related entity may set internal prices when transferring goods, services, loans, and intangible assets. These regulations apply in domestic and international contexts. The general goal of the transfer pricing regulations is to equate a controlled transaction with a non-controlled transaction. Non-controlled is where goods and services are sold to a third party in an arm's-length transaction. A controlled transaction is where you're selling from one entity to a related entity. Oftentimes this is done to try and control in which market the majority of the gain or loss is recognized on a transaction. Consider this example. You're going to sell a widget for $10. Okay, if you sell it from organization A to organization B for $8, and then ultimately from organization B to an end user for $10, that's a $2 gain on that transaction, recognized in the US market. How about if you sold it for $6 between organization A and organization B? Well, when organization B sells it in US markets for $6, that's a $4 gain. You can see that by controlling transfer pricing, you can pick which market recognizes the majority of the gain. Of course, you want to recognize the majority of the gain in the jurisdiction that has the lower tax burden. Transfer pricing regulations try and stop this perceived abuse. Again, the arm's length regulations are considered comply with when a controlled transaction between related entities is on par with a non-controlled transaction between arm's length parties, as in an open market transaction. One method to avoid potential penalties and interest surrounding the transfer pricing regulations is to engage in an advanced pricing agreement with the U.S. government before you enter the U.S. market as to transfer pricing.